The concept of confidence in trading is one of the most profoundly misunderstood pillars of success in the financial markets. The common imagination conjures an image of the brash speculator, a figure of unyielding certainty who calls market tops and bottoms with divine precision, whose very posture radiates an invincible, "I cannot lose," bravado. Yet, this caricature does not represent confidence. It is the embodiment of ego. An ego, by its very nature, is a fragile construct, a crystal glass waiting for the first stone of market reality to shatter it. True confidence, in stark contrast, is an entirely different entity. It is quiet, steadfast, and unshakable. It is the cultivated capacity to trust your meticulously crafted plan even when every primal instinct within you is screaming in panic. It is not the loud voice of prediction, but the silent foundation upon which all consistent, long-term success is irrevocably built. Before we continue, make this commitment. This channel isn't about quick fixes, it's about developing traders with mental strength and discipline. If that resonates with you, join us. Subscribe now so you don't miss any of our upcoming videos. Stay until the end and keep progressing with us, one mindset shift at a time. This video isn't just another trading video, it's a mirror for your mindset. Like now, comment what resonates, and stay until the end. Because one idea here could change how you think, and how you trade. Let's go. Recall, with vivid clarity, the first trade you ever executed. The experience was likely a potent cocktail of exhilaration and sheer terror. Your heart hammered against your ribs, a frantic drumbeat synced to the flickering price ticks. Your palms grew damp, your focus narrowed to a single, pulsating scream. Every upward twitch felt like a personal validation, a glimpse of genius, while every minor retracement registered as a stinging personal defeat. In that heightened state, you were not operating from a place of confidence. You were entirely reactive, a marionette whose strings were pulled by the twin puppeteers of hope and fear. You lacked a foundation, and without that bedrock, every single trade inevitably feels like a roll of the dice, a gamble on the unpredictable whims of fortune. Tragically, this is the purgatory where the majority of traders reside for years, even decades, trapped in a perpetual pendulum swing between euphoric hope and debilitating fear. They place trades without a soul-deep belief in their own system. They hesitate when their own criteria for a perfect setup materialize before them, paralyzed by the ghost of past losses. They second-guess their exit signals, and in doing so, they sabotage their own mathematical edge. They close positions prematurely because the sibilant whisper of fear convinces them a small profit is safer than a potential loss. Or, conversely, they hold on to losing positions far beyond their predefined stop-loss, seduced by the siren song of greed that promises a reversal is just moments away. This cycle of self-sabotage is not, at its core, a reflection of a lack of skill or a deficient strategy. It is a glaring symptom of a profound lack of confidence. Without this essential inner fortitude, even the most statistically robust and brilliantly conceived strategy becomes worthless, a master key in the hands of someone who does not believe it can unlock the door. It is critical to understand that confidence is not forged in the white-hot crucible of a live trade. That is far too late. Its construction occurs long before the market opens, in the quiet, unglamorous hours of preparation. It is the product of relentless study, systematic testing, and the deep, almost subconscious internalization of your statistical edge until it becomes an inseparable part of your trading psyche. Consider the analogy of a veteran pilot navigating a violent storm. They do not succumb to panic at every flash of lightning or jolt of turbulence. Their calm is not born of recklessness, but of an absolute trust in their years of training, the reliability of their instruments, and the efficacy of their established procedures. They have mentally and practically rehearsed for this exact moment countless times in simulators before they ever left the ground. A trader must adopt this same preemptive mindset. You cannot wait until real capital is on the line to conduct a philosophical debate with yourself about whether you truly trust your system. That decision, that covenant with yourself, must already be made, signed, and sealed. Yet, herein lies the fundamental error that ensnares the majority. Most traders never submit their systems to the rigorous, unflinching trial they require. They engage in a form of intellectual plagiarism, copying strategies from online forums, absorbing a handful of YouTube tutorials, and then leaping headfirst into the live markets. They risk their hard-earned capital on untested, unproven methods. When the inevitable, and statistically necessary, losing streak arrives, as it surely will for any system, their fragile, borrowed belief shatters into 1,000 pieces. Of course it does. There was never any genuine confidence there to begin with, only a transient, fragile hope leased from someone else's perceived success. Authentic, durable confidence is exclusively born from doing the work yourself. It is earned through the meticulous process of backtesting your strategy across hundreds, if not thousands, of historical trades, across bull markets, bear markets, and sideways chop, until you can visually and statistically see the edge emerge from the data. It is solidified through forward testing in a simulated environment, observing how the system behaves in real time, experiencing the emotional cadence of both winning and losing streaks without the distorting lens of financial consequence. Only after passing through this gauntlet of verification does a genuine, resilient confidence begin to take root. For confidence is not blind faith, it is informed trust. However, even with a mountain of corroborating data, a deeper, more philosophical layer is required. You must learn, absolutely and unconditionally, to decouple your confidence from the outcome of any single trade. This is the watershed moment where many traders, even those with robust systems, ultimately fall apart. They labor under the misapprehension that confidence must equate to winning all the time. Consequently, when they experience a loss, their perceived confidence evaporates. But this is not confidence, it is a pathological dependency on positive reinforcement. If your belief in your plan only exists during winning streaks, then you do not truly believe in the plan itself. You are merely addicted to the dopamine hit of favorable results. True, professional-grade confidence means placing a trade, watching it move against you, losing the allocated capital, and yet still possessing the inner certainty that you made the correct decision because you adhered to your predefined rules without deviation. It means being able to mentally shrug off a loss, not with apathy, but with the understanding that this single event is a non-negotiable part of the larger probabilistic equation. Professional traders lose money on a regular basis. The critical distinction is that their confidence is not tethered to the P&L of a single trade. It is anchored to the integrity of their process. They know, with mathematical certainty, that if they execute their edge consistently over a large sample size, the laws of probability will deliver the results. This cognitive shift, detaching confidence from short-term outcomes, is arguably the most difficult psychological hurdle for any trader to clear. We are culturally conditioned to measure success by immediate, tangible results. In academia, your worth is your grade. In athletics, your value is the score. Importing this outcome-dependent mindset into trading is a lethal error, because in the probabilistic world of the markets, no single outcome possesses any meaningful significance. Only the aggregate collection of outcomes over time matters. Confidence, therefore, emerges from a deliberate act of zooming out, from reconceptualizing trading as a marathon of thousands of steps, not a frantic sprint to the next profit. But let us be unequivocally honest, this is not easy. When your own capital is at stake, every tick of the price can feel like a personal judgment. Every red candlestick on the chart can feel like a targeted assault on your intelligence and capability. So, how does one maintain this stoic confidence while watching real money evaporate on the screen? The answer lies in a fundamental recalibration of your definition of success. If you are measuring your performance in dollars and cents, you are chaining your emotional state to the random walk of the market, and you will never find stability. However, if you measure success by the quality of your execution, by your discipline in following your plan, your adherence to your risk management rules, your patience in waiting for your edge, then confidence becomes unshakable. Why? Because these elements are entirely within your sphere of control. Before we delve further into the architecture of this mindset, it is worth a moment of stark self-assessment. Are you currently struggling with the insidious trio of fear, doubt, and overtrading? The unvarnished truth of the trading world is that most participants do not fail because of analytically poor strategies. They fail because of psychologically poor self-governance. This is the very raison d'etre for my comprehensive guide, Master Your Mind, Master Your Trades. It is a deep dive into the practical mechanics of controlling your emotions, forging unbreakable discipline, and operating with the detached proficiency of a seasoned professional. If you are genuinely ready to transcend your current limitations and elevate your trading to its highest potential, the resource is available to you. You will find the link in the description and the pinned comment below. Now, let us return to our exploration. Consider the parable of two traders, both starting with identical account sizes and an identical, statistically sound trading strategy. Trader A focuses myopically on profits. Every loss is a devastating personal failure, a narrative of his inadequacy. Every win is a euphoric event that validates his genius. His confidence is a direct derivative of his account balance, a roller coaster of soaring highs and crushing lows. Trader B, in contrast, focuses exclusively on the process. He has internalized the math of his strategy, a 50% win rate with a 2-to-1 reward-to-risk ratio. He not only intellectually understands but emotionally accepts that approximately half of his trades will be losers. His confidence is rooted not in the outcome of the next trade, but in the ironclad trust that if he executes his plan with robotic consistency, the mathematics will inevitably work in his favor over the long run. Trader B loses just as frequently as Trader A, but his confidence remains a steady, unwavering line. It is rooted in trust, not in the fleeting winds of emotion. This illuminates why trust is the ultimate currency in trading. Trust is the essential bridge that connects intellectual knowledge to decisive action. You can know your edge inside and out, you can recite its statistics flawlessly, but if you do not trust it at a gut level, you will never act upon it with consistency. You will commit the classic errors, cutting winning trades short, moving stop-loss orders further into danger, overtrading out of boredom or frustration, and, most catastrophically, abandoning your entire system at the precise moment it is poised for a recovery. Trust is the psychological substance that allows you to stay the course when the siren song of doubt is screaming in your ear. So, how is this vital trust constructed? It begins, unglamorously, with repetition. Every single time you follow your trading plan to the letter, even on, and especially on, a losing trade, you are making a deposit into your psychological bank of trust. You are reinforcing the neural pathway that says, my system is reliable, and I am reliable. Conversely, every time you abandon your plan, you make a withdrawal, weakening that foundational trust. Confidence is a psychological muscle. Its strength is built through the relentless exercise of disciplined execution. If you repeatedly betray your own rules, you are actively atrophying that muscle, until it can no longer support you when you need it most. This is why discipline and confidence are two sides of the same coin, they are inseparable. Without the former, the latter is merely wishful thinking, a phantom limb. There is another, more subtle piece to this psychological puzzle, the power of internal dialogue. The running commentary you maintain in your own mind during trading hours actively sculpts your confidence landscape. If, in the aftermath of a loss, you indulge in a destructive monologue, I'm terrible at this, I have no edge, I will never succeed, you are systematically dismantling your own belief system from the inside out. You are the architect of your own ruin. But if, after that same loss, you consciously affirm, I followed my plan perfectly, I managed my risk appropriately, the outcome is irrelevant to the quality of my execution, you are pouring psychological concrete into your foundation. Confidence is built not only on data and discipline but also on the deliberate, curated dialogue you choose to entertain within the private theater of your mind. And we must not overlook the virtue of patience. Confidence is not a switch that can be flipped on after a few successful trades. You cannot expect to possess a deep, unshakable belief in your system after a mere handful of executions. It takes months, and often years, of repetitive, consistent action to internalize trust at the deepest, subconscious level. The more screen time you accumulate with your strategy, the more familiar its behavior becomes. Its rhythms, its drawdowns, its winning streaks, all become second nature. Confidence grows not like a weed, overnight, but like the roots of a great oak tree, slowly, invisibly, but with immense, gathering power beneath the surface. The great irony of this entire pursuit is that most traders chase confidence in precisely the wrong direction. They attempt to force it into existence by winning more trades, by avoiding losses at all costs, by engaging in a perpetual, futile search for the Holy Grail strategy. But perfection is a mirage in the desert of the markets. Losses are not a possibility, they are an inevitability. Drawdowns are not an anomaly, they are a feature. Uncertainty is not a problem to be solved, it is the fundamental condition of the environment. The sooner you fully and unconditionally accept these truths, the sooner the seeds of genuine confidence can begin to sprout. For confidence is not about eliminating uncertainty. It is about learning to stand firm, calm, and resolute within the storm of that uncertainty. Confidence in trading is not loud or boastful. It does not need to announce its presence. It is the quiet, internal voice that states with calm assurance, I know my edge. I know my rules. I understand my probabilities. And I will follow them with discipline, regardless of the outcome of this single trade. This is the only form of confidence that is durable. This is the confidence that builds sustainable trading careers, as opposed to the fleeting bravado that inevitably blows up trading accounts. Therefore, as you take an honest inventory of your own trading journey at this very moment, you must ask yourself the most critical of questions: do you truly trust your plan? Or are you still seeking confidence in the wrong places, in the dopamine hit of short-term wins, in the borrowed authority of another trader's strategy, in the fleeting and fickle winds of your own emotions? Until you construct a real, earned trust in your own process, consistency will remain a phantom, always just out of reach. And here is the ultimate truth, the prize that awaits on the other side of this psychological work. Once you have built that foundational trust, your entire trading reality transforms. Fear loses its visceral grip. Greed is quieted from a roar to a whisper. Doubt may still visit, but it no longer has the power to move you. You are liberated from the exhausting burden of needing to predict the market's every move. Your only task is to execute your edge, again and again. You no longer chase the addictive thrill of being right on a single trade. Your focus narrows to the serene satisfaction of being consistently disciplined. You no longer crumble during inevitable losing streaks. You stand steady, anchored by the knowledge that your system and your discipline will carry you through the temporary storm. This is the bedrock of true confidence. This is the genesis of genuine freedom as a trader. Imagine this scenario, a test that unfolds daily for traders worldwide. You have just executed a meticulously planned trade. You identified your key support and resistance levels, you waited with disciplined patience for your specific setup to congeal on the chart, and you finally clicked the buy or sell button with conviction. In that initial moment, you felt a surge of strength and control, certain in your analytical decision. But then, just minutes later, the price candle moves a few pips against your position. Suddenly, your physiological state shifts. Your heart rate accelerates, your palms moisten, and that solid belief you held moments ago begins to fissure and crack. The plan that felt bulletproof now feels flimsy and suspect, and the venomous whisper of doubt infiltrates your mind. This is the silent, internal battle that most traders lose, not because their strategy was inherently weak, but because their confidence was not robust enough to withstand the psychological pressure of being temporarily wrong. This fragility exists because confidence, for the untrained, is often contingent on short-term validation. When a trade is immediately profitable, you feel like a market savant. When it moves into the red, you question your entire education and aptitude. This emotional roller coaster is the primary engine of inconsistency, because your sense of self-efficacy is tied to the random noise of individual results rather than the steady signal of your habitual process. A trader who depends on wins for their psychological stability is like a magnificent house constructed upon sand. It requires only one significant storm, one sharp, unexpected drawdown, to bring the entire structure crashing down. The true objective is to build confidence like a fortress, with foundations of reinforced concrete, something that does not tremble just because the market does not provide instant gratification. Doubt is the perpetual shadow that trails every trader, growing longest in moments of hesitation. You witness a textbook setup forming according to your plan, but instead of acting, you freeze. Your mind spirals through a catastrophic loop. What if I'm wrong again? What if my analysis is flawed? What if this is the loss that breaks me? That hesitation, that failure to act, is often more costly than any single losing trade. Why? Because it actively reinforces the debilitating habit of second-guessing your own judgment. Each time you hesitate, you weaken the critical muscle of decisiveness. Each time you abandon a valid trade signal out of fear, you are training your brain to distrust the very system you work to create. Doubt, through this process of negative reinforcement, slowly but surely erodes the foundation of confidence until the act of trading feels less like a disciplined profession and more like a high-stakes gamble. Reflect upon the traders who are trapped in the endless cycle of strategy hopping. One week they are scalping on a 5-minute chart, the next they are swing trading on daily time frames. This behavior is not necessarily a sign of a poor learner, but rather a symptom of seeking confidence in an external object, the perfect system. They operate under the delusion that the right combination of indicators and rules will finally exorcise the demon of doubt, when in reality, no system in existence can achieve this. The fundamental truth is that markets are, by their very nature, uncertain and probabilistic. A robust trading plan provides a necessary structure and an edge, but no plan can ever eliminate risk. The traders who not only survive but thrive are those who have internalized a more profound understanding that confidence is not about certainty in the market's movements, but about certainty in themselves to follow their process, no matter what the market does. This leads us to a core paradox: the more frantically you chase certainty, the weaker and more fragile your confidence becomes. You will never discover a trading method that guarantees a win on every single trade. Yet, legions of traders waste years, even decades, in this futile quest. They fail to realize that their lack of confidence does not originate from the market's inherent unpredictability. It emanates from within themselves. They do not trust their own discipline. Consequently, they outsource their confidence to external crutches, to the latest complex indicator, to the charismatic guru on social media, to the opinions of others. This dependency, far from being a solution, only deepens their internal doubt. You can possess the most sophisticated technical analysis skills in the world, but if you lack the inner conviction to follow your own rules, you will inevitably become your own worst saboteur. Consider a concrete example: a trader enters a position with a clearly defined stop-loss and profit target. Midway through the trade, price action dips menacingly toward the stop-loss, hovering just above it without triggering it. Consumed by fear, the trader manually closes the position early to avoid the perceived certainty of the stop being hit. Minutes later, the market reverses precisely as the original analysis suggested and rockets up to hit the profit target. The failure in this scenario was not in the strategy's logic, which was ultimately correct. The failure was a complete collapse of confidence. This trader did not trust the plan, and thus surrendered to doubt, locking in a guaranteed, self-inflicted loss instead of allowing the probabilities the room they require to play out. The chasm that separates a confident trader from a doubtful one is not primarily a gap in skill or knowledge, it is a canyon of difference in belief. The confident trader accepts the possibility of the loss but chooses discipline over emotional comfort. The doubtful trader allows fear to dictate their actions and, in doing so, sabotages their own potential for success. It is vital to recognize that confidence is not built during winning moments, it is forged in the fire of losing moments. Anyone can feel confident and disciplined when their trade is already in profit. But when the market actively tests your resolve, when the trade moves decisively against you, when your account statement shows a tangible hit, that is the true crucible of confidence. It is in these exact moments that you make the definitive choice: will I honor the promise I made to myself and my system, or will I abandon my principles in a panic? Confidence is the cumulative result of keeping promises to yourself. Every time you follow your plan despite the intense discomfort, you strengthen that inner covenant of trust. Every time you betray your own system, you weaken it. Confidence, therefore, grows not from favorable outcomes, but from unwavering consistency of action. The market will forever be a tempter, a psychological adversary that seeks to exploit your weaknesses. It will whisper seductively, "Take the profit now, before it disappears." It will scream in panic, "Close this trade before you lose everything." It will mock you with false breakouts and vicious, sudden reversals. But confidence is not about silencing these external and internal voices. That is an impossible task. It is about developing the quiet power to hear them, acknowledge their presence, and still deliberately choose to follow through with your predefined plan. It is the steadfast mantra, "I trust the process. Win or lose this one, I trust the process." This single mindset is what transforms trading from a frantic, emotionally draining chase for certainty into a calm, disciplined execution of statistical probabilities. One of the most challenging truths to accept is that confidence and doubt are not mutually exclusive. They will always coexist within a trader's psyche. You will never completely eradicate fear or hesitation. The goal is not to become an emotionless robot, but to learn which internal voice you grant authority to. Every single trade you take is an opportunity to cast a vote. You are either voting for your confidence or for your doubt. Over time, through hundreds and thousands of these micro-decisions, these votes accumulate to shape your core identity as a trader. Are you someone who trusts your own judgment and process, or are you someone who panics at the first sign of adversity? Your long-term results will be a perfect, unerring reflection of that chosen identity. The inherently fragile nature of nascent confidence means it requires daily, active reinforcement. Like a muscle, it will atrophy without consistent training. This is why the practices of journaling, systematic trade review, and honest self-reflection are not merely administrative tasks, they are critical psychological maintenance. They serve as your personal ledger of truth, reminding you of the bigger probabilistic picture when the myopic lens of doubt clouds your judgment. Confidence is not a feeling that descends upon you like a blessing. It is a discipline, a skill you consciously build. Through 1,000 small, correct decisions day after day. When you choose patience over impulsive panic, when you hold your stop-loss inviolate instead of sliding it into danger, when you accept a loss with professional grace instead of immediately seeking revenge, these are the repetitions that strengthen your inner foundation. In the final analysis, confidence in trading is not a matter of predicting the future. It is a matter of trusting yourself enough to take decisive, calculated action despite not knowing what the future holds. Doubt will always be present, a thief trying to steal that hard-earned trust. But it cannot succeed if you refuse to hand it over. The more you train yourself to follow through on your commitments to your system, the less fragile your confidence becomes. It evolves from a brittle shell into a resilient, flexible core. And once you arrive at that point, trading ceases to feel like a daily battlefield between the warring nations of fear and hope. It transforms into a steady, purposeful march forward, a journey built upon the unshakable triumvirate of self-trust, unwavering discipline, and profound psychological resilience. There arrives an inflection point in every trader's journey when the central conflict is no longer fought on the charts, in the strategies, or in the economic news flow. The war becomes entirely internal. The ultimate challenge is not whether your trade hits its profit target, but whether you possess the deep-seated trust in yourself to allow the statistical probabilities the time and space to unfold. Confidence in trading is not a treasure you stumble upon by luck. It is a structure you deliberately and painstakingly build, brick by psychological brick, decision by disciplined decision. The goal is to reach a state of equilibrium where you do not fragment after a string of losses, nor do you become intoxicated with euphoria after a series of wins. Instead, you become a portrait of steadiness, calm, focused, and fundamentally unshakable. To construct this edifice, the first non-negotiable truth you must integrate is that losses are an inherent, inescapable part of the trading equation. Far too many traders allow losses to corrode their belief system. A single losing trade is interpreted as a personal indictment, a verdict that they are not skilled or intelligent enough. The most successful traders, however, operate from a different paradigm. A loss is not a verdict on their ability, it is simply a data point in a large statistical sample. If you risked a prudent amount of capital and followed your plan with discipline, then even a losing trade is, paradoxically, a victory. It is a victory of process over emotion. Each time you respect your stop-loss without hesitation, you are not destroying confidence, you are building it. This cognitive reframing is absolutely crucial. You must shift from measuring your success and self-worth by your P&L, to measuring it by your fidelity to your own rules. A cornerstone of unshakable confidence is the cultivation of emotional neutrality. Picture a world-class professional poker player. They do not leap from their seat in triumph when they win a single hand, nor do they collapse in despair when they lose a big pot. They understand that the game is defined over thousands of hands, not by the outcome of any single one. A trader must cultivate this same detached, long-term perspective. Overexcitement after wins can be just as perilous as despair after losses, as both emotional extremes cloud judgment and weaken disciplinary resolve. True confidence manifests as approaching every trade with the same calm, methodological focus, irrespective of its eventual color on your screen. Another indispensable pillar is exhaustive preparation. Confidence does not emerge from reciting positive affirmations or trying to force yourself into an optimistic state. It is the natural byproduct of knowing, without a shadow of a doubt, that you have done your homework. When you have spent countless hours backtesting your strategy, meticulously journaling your trades, ruthlessly reviewing your errors, and refining your risk management protocols, you approach the market from a position of preparedness. This thorough preparation is what breeds authentic trust. You no longer feel the compulsive need to second-guess every entry and exit because you have tangible evidence and experiential knowledge that you have a verifiable edge. The more prepared you are, the more your confidence transitions from a fragile emotion, susceptible to every market whim, into a solid conviction based on evidence and experience. Discipline is the engine that drives this entire mechanism. It is the active component that transforms preparation into confidence. Every single time you adhere to your rules, especially when it is psychologically painful to do so, you reinforce your identity as a disciplined trader. And this self-reinforcing loop is powerful. The more disciplined you are, the more confident you become. Imagine two traders, as before. One consistently breaks their own rules, entering on impulse, exiting out of fear. This trader's confidence will forever remain shaky because, at a fundamental level, they know they cannot rely on themselves to do the right thing. The other trader follows their system with relentless consistency, regardless of short-term outcomes. This trader is building the most valuable asset of all, a reputation with themselves. They are proving, through action, I am a person who can be trusted. Over time, this self-trust matures into the unshakable confidence that defines the professional. Yet, a profound paradox resides at the heart of this endeavor. Building unshakable confidence requires you to willingly embrace vulnerability. You must be open to facing discomfort, uncertainty, and fear directly, without flinching. Every time you resist the powerful urge to close a trade prematurely, every time you accept a loss without immediately seeking revenge, every time you sit on your hands and do nothing when there is no valid setup, you are not just executing a trade, you are strengthening your psychological resilience. You are proving to yourself that you can endure the uncomfortable emotions that bankrupt the majority of market participants. Confidence, therefore, does not mean the absence of fear. It means that fear has been demoted from the director of your actions to a mere background noise that you acknowledge but do not obey. Return to the pilot analogy. Passengers in turbulence may panic, gripped by fear, but the pilot remains composed. This calm is not born from knowing the turbulence will end immediately, but from an unshakable trust in their training, their aircraft, and their procedures. This is the operational state of a confident trader. The market may swing wildly, other participants may be liquidating in panic, but the confident trader remains steady. Not because they possess a crystal ball, but because they trust their preparation and their discipline to navigate the storm. This sequence is where many falter. They want the feeling of confidence to magically appear before they exercise discipline. They wait to feel good or feel sure before they follow their rules. But the causal relationship is reversed. Discipline is the cause, confidence is the effect. You build confidence by repeatedly, doggedly doing the hard thing, the right thing, especially when every fiber of your being is pulling you in the opposite direction. Only through this repeated action does confidence take root and flourish. It is the earned reward for showing up, sticking to your process, and proving to yourself, day after day and trade after trade, that you are a person who can be trusted. Unshakable confidence also demands the perspective of long-term vision. If your focus is myopically locked on today's single trade, then every win or loss feels like a matter of survival. But when you zoom out to the wide-angle view of your performance over weeks, months, and years, individual trades lose their capacity to destabilize you. Confidence flourishes in this expansive view, where you understand that one trade does not define you. You are not your last trade. You are the sum total of your discipline, your process, and your consistency over time. By embracing the long game, you inoculate yourself against the emotional whipsaw caused by the randomness of short-term results. Finally, confidence in trading is inextricably linked to your core self-identity. You must ask yourself, and answer with brutal honesty, who are you when you step into the arena of the markets? Are you a person who panics under pressure, or a person who executes with stoic discipline? Are you a person who chases impulsive whims, or a person who respects a proven process? The narrative you construct about yourself becomes a self-fulfilling prophecy. If you identify as weak, fearful, and inconsistent, your actions will inevitably conform to that identity. But if you make a conscious, definitive decision that you are a disciplined, confident trader, you will gradually begin to act in alignment with that new, empowered identity. Your behavior reinforces your identity, and your identity, in turn, reinforces your confidence, creating a powerful positive feedback loop. The market will never cease to be a testing ground. It will perpetually present you with uncertainty, temptation, and emotional turbulence. But unshakable confidence does not mean you are immune to these forces. It means you have learned to stand firm at the epicenter of the storm, grounded in the bedrock of your preparation, your discipline, and your ironclad trust in your own ability to execute. It means you are no longer swayed by the cacophonous noise of short-term results because your foundation has been engineered to be too deep and too strong to be shaken. And once you attain that level of integration, trading ceases to be a battle with yourself. It becomes a pure expression of who you have chosen to become, a disciplined, focused, and truly confident trader, capable of trusting your plan and, most importantly, yourself, no matter what the market throws your way.